Thank you, Jerry, for joining us this evening.
All right, thanks, Kim. And I'd also like to say good evening and welcome to all of those that are listening in on our webinar today. On behalf of my partners, Kim Brown and Raman Harmon, just want to say thank you for attending. And today we're going to talk a little bit about investing in notes during economic crises. One of the things that we hear about a lot today in the news, we hear about tariffs, we hear about trade wars, inflation. Are we going to have a recession? All of those kinds of things. And what we've learned is that the note investment world is a good way to hedge against those kinds of uncertainties in the market. So over the course of the next few minutes, that's what we're going to be talking about today. In terms of this presentation or in this webinar, we're going to give you a little bit of an understanding of mortgage notes as an investment opportunity, as an alternative investment opportunity. We're also going to talk about why notes are resilient during economic crises, that it provides consistent, steady cash flow. It's a good way to diversify your portfolio. And then we're also going to run you through some case studies. And we like to be able to show a little bit of what we know and what we've learned about the note business and how we're able to take advantage of some of the things that we've learned. First of all, I just want to tell you a little bit about First Shield and what we're trying to do and our mission. Our focus is primarily on unlocking the potential of mortgage notes for our clients. We're committed to providing innovation, reliable investment solutions, and we do all of that within a framework of expertise, integrity, and a results-oriented strategy. So, as many of you have seen, there are headlines every day about the stock market and what's going on. Tech stocks going up, tech stocks going down. The economic sentiment that you hear in the market, things that affect elections and so forth, are typically surrounding the volatility of the stock market. And one of the things that kind of jump out at us is why the volatility? Is that a cause for recessions? There are other external issues that affect the market. What's going on between the U.S. and China? What's our relationship? As you're looking at these things, one of the things that kind of runs through most people's minds is, how do I protect my investment? How do I protect the assets that I've worked really hard to be able to build to make sure that those assets don't disappear? My own personal experience, I have seen the results of a market meltdown. And I can tell you what it's like to lose tens of thousands of dollars a day as a market collapses. So one of the things many folks are worried about is, what can you do in order to be able to hedge against any financial calamities that may pop up over time? As a result of that, one of the things that we look at is the note as a hedge against a lot of that uncertainty and a lot of that volatility. Next slide, Kim.
Yeah, I was trying to let somebody else in the room. Sorry.
Okay.
Okay.
So one of the things that I want to talk about is I want to help you understand how notes can be a really good investment for your portfolio. One of the things to keep in mind is that for First Shield, we invest in both performing notes, which are notes where people are paying every month, as well as non-performing notes, which people are notes where people are not paying or they may be in default. Our rationale and our strategy behind this is that for performing notes, we invest in that for cash flow. And what we'll talk to our investors and our clients about is getting a monthly payment. So a performing note, that's what all of us are familiar with. You're getting a monthly payment, and because people pay their mortgage. A non-performing loan, we invest in those for both the capital appreciation as well as the cash flow. Ultimately, we figure out a way to get the non-performer to perform, and we'll get cash flow out of it. But for the most part, We invest in those notes because bad things happen to good people, and we know that over the long haul, we will be able to get good cash flow out of those notes as well. One of the things that I said at the beginning of this presentation is that there's a lot of volatility in the market. The notes that we're investing in, mortgage notes, are not correlated to the market, and they're also not they're not correlated well to the overall economy. What we mean by that is that when you buy a note, and the note is secured by real estate, which is a tangible asset. A lot of times when I'm talking to my partners, I'll say, we're buying the right to have that dirt. So there's a house on it, and it's sitting on some land. That land is not going to go away. So that's one of the things that makes us resilient. The other thing that makes us resilient when the economy starts to get crazy, and again, there's lots of volatility, is that the payments are regular. They're steady, and even in a downturn, people are going to pay their mortgage. If you think about your own personal situation, you think about your budgets, you think about the bills that you have, one of the first things you pay every month is for a roof over your head. The notes that we buy are from properties where people are trying to keep a roof over their head, so they're paying their bills. So again, why the resilience? Regular payments. The other thing that we've noticed over time is that historically, notes tend to outperform other assets during a recession. And in some cases, that's kind of counterintuitive. It's like, well, why is that? Well, what happens is it's that the notes are so steady, even in a downturn, they're steady, and the other asset classes fall off. So as a result, your other asset classes start to decline, and notes just continue to grow. One of the things that we'll say, particularly with our performing notes, is that they're boring. And the reason they're boring is that, as I see, constantly this time of the month, I get more emails from our servicing company saying, we've just deposited more money into your account. So notes outperform because of that steady, regular payment. The other thing that I'll say about that is it's about the cash. And because the notes are providing the payment, you have regular cash. And again, it's not as volatile. I want to shift gears a little bit and talk to you about the Covenant Fund. Covenant Fund 1 is a fund that we put together to invest in high return real estate mortgage notes. And the purpose of that fund is really to try to take the expertise that we have in the note space and be able to provide that for a broader audience. One of the reasons we started the fund, quite frankly, is that one of my mentors saw what we were doing and saw the returns we were getting. And it's sort of like, well, I want a piece of that. And the way to get me to give him a piece was, why don't you have a fund so I can invest and get some of the return that you're getting? So that's why we set it up. The other thing that I'll say about the Covenant Fund, it's for those folks that hear about our note investing, but they really want a passive income stream. Covenant Fund 1 was set up to be able to give those investors that passive income, and it also takes advantage of the expertise that our team here has built over the last several years in the note space. So you get the chance to participate right along beside us in getting the types of returns that you're looking for. So in the Covenant Fund, we basically are investing in two types of notes. We primarily buy second liens, which are HELOCs, home equity lines of credit. We buy both performing and non-performing. The fund is set up to be able to do residential primarily, but also do commercial when we see some opportunities there. The other thing that we will do is we'll invest a little bit in some short-term loans. And again, that's to be able to get us that steady, regular cash flow in order to be able to pay our investors off. In the course of, and as we're building this fund, our investors get a chance to get the capital appreciation from the non-performing loans, as well as the regular cash flow from performing loans. And overall, you'll get an above average return for this kind of fixed income asset class. One of the things that, I've introduced the fund, but I want to really kind of dive a little bit deeper to give you an idea of how the fund works. First of all, we only buy what we feel are very high quality mortgage notes, whether they're performing or non-performing. We do a very deep dive in our due diligence, and we try to make sure that we have a very large geographic dispersion so that, events in any part of the country don't really affect what's going on with our portfolio. The other thing is we use a very strict purchase requirement. We have what we call a buy box, a narrow set of criteria that we're looking for. We want to make sure that there's equity in the house. We want to make sure the houses look good, that they're in good neighborhoods, that the economics for the cities that they're in work out well as well. We do a very heavy due diligence on every note that we buy, right down to making sure that we have somebody we get eyeballs on the property to make sure that we know what the house looks like or the property looks like before we make that investment. The other thing that I'll tell you is that the team that we have at First Shield is one of the strongest investment teams that you're going to find in this space. And the reason is we have members of our team that are real estate agents, licensed appraisers, folks that are specialists in compliance. We have licensed mortgage lenders, loan originators, contractors. We know how to evaluate an underlying asset. We know how to evaluate the property. We look at the property. We look at the note itself. We look at the seller of the note, the geography, and we also look at the borrower to make sure that we're buying a note that has the type of quality that we're looking for, to be able to make sure that we're doing the right thing for our investors and that our investors will get that yield that they're looking for. The next thing that we have in our fund is we have a quarterly payment. So all of our investors once a quarter get a payout based on the amount of money that they've invested in the fund. And we'll talk a little bit more about what that yield looks like in a slide a little bit later. At the end of the fund, this is a 5-year life, and our fund sunsets in 2029. 100% of the capital that an investor has invested will be returned. And in addition to that, and in addition to the quarterly payments, all of our investors will get a chance to receive up to half of the profits that were generated by the fund. As I mentioned, by buying non-performing notes, we get a lot of capital appreciation, and that will be given back to our investors, our fund investors. If you want to learn a little bit more about the Covenant Fund, you can scan this URL and schedule a call with myself or with Kim or with Raman to talk a little bit more in detail so that we can understand what your investment requirements are, and we can help you to understand how the Covenant Fund may work in your investment portfolio and how it will fit. The next thing I want to talk about with notes is what we call the 3 immutable facts. With mortgage notes, and the reason we like mortgage notes and the reason we started investing in these is that there are only 3 things that can possibly happen with this investment. If you think about other investments that you're looking at, stock market, lots of volatility, lots of things can happen. In the note space, only 3 things can happen. 1, the borrower pays as they've agreed. If you think about it, if you have a mortgage, you know that you pay your mortgage every month. The other factor, which most people don't think about, is that the mortgage may get paid off early. And if the mortgage does get paid off early, we get a little bit better return on our investment. And they get paid off early because interest rates change and people refinance their house. They sell their house to move to a bigger house, move out to a different neighborhood, that kind of thing. So that's what the early payoff is about. The final thing that can happen is the borrower fails to pay. That happens in a small number of cases, but even with failure to pay, we go back to their 3 immutable facts. What we do with a note that is non-performing, that's in default, is we'll work with the borrower to come up with a payment plan that will work for them. So again, we get back to paid as agreed. If we can't work out something there, we may work with the borrower to help them sell the house or to get that house refinanced so that they can get a lower overall payment and maybe take cash out of the house as well. Finally, if we're not able to do one of those first two things and we are at a point where we're at an impasse, we'll work with the borrower. We may offer the borrower money just to have them step away and we take the house, or we'll ultimately, we may be forced to foreclose. So those are the three things that can possibly happen. And from our perspective, all of those are manageable and none of them are scary to us. As we talk about note investing and what it does to protect your portfolio and how does it provide diversification, one of the things that we like to talk about is as you're building your overall investment portfolio, you invest in a lot of different classes of assets. That's one of the things that people are encouraged to do when they're building their portfolio. When you're talking to your financial advisor, they'll put you in stocks, they'll put you in bonds, they'll put you in real estate, they'll put you in a lot of different things. Notes are a way for you to diversify your portfolio to reduce the overall volatility. So when things are down, your notes are still performing. When things are up, you're still getting that performance. The other thing that's a good reason for investing in notes is that there's a low correlation to other asset classes. Like I said, notes are not tied to the economy. They're not tied to interest rates. They're not tied to the economics, elections, and things of that sort. So there's a low correlation to other things that are kind of volatile in your portfolio. And then finally, because of those strong cash flows, the steady cash flows, you get a much stronger overall over the life of your portfolio, a stronger performance because it's so predictable. Getting back to what we do at First Shield and with the Covenant Fund, I mentioned that we invest and we try to have a very diverse portfolio. We invest over in most states in the country. As you see on the chart, we don't do the West Coast, Washington, Oregon, California. We also stay out of New York, New Jersey, Massachusetts. And to a limited extent, we'll stay out of parts of Illinois. And that's just because of the experience that we have with how do you best manage your note portfolio. I'd like to give you kind of a case study so that you get a real world feel for what happens with us with our notes. And as I mentioned, we buy non-performing notes, and this can kind of help you walk through what the capital appreciation really looks like for a non-performing note. I've used this example on a couple of occasions, and we'll talk to you about it a little bit today. This is one of the loans that we bought a few years back that's in the District of Columbia. And this is kind of, like I said, an example of capital appreciation with a note. The property that was underlying this note, first of all, it's a non-performing second loan. So the property behind this note was worth about $500,000. So it was a nice property, probably mid-range price in the DC area, but it was a nice property. The first mortgage on the loan was $230-something thousand, and the borrower was paying on that loan. The second mortgage, which is what we bought, had a unpaid balance of about $48,000 and unpaid interest and late fees of about $44,000. The borrower hadn't paid on this thing for about a decade. So it had been sitting out there for a while and accrued a lot of interest as it was sitting there. Overall equity in the house after paying off the loans would be $171,000. So from our perspective, this was a slam dunk note. It's a note in a good geography, in an area that's growing, that's economically pretty stable, and there's a lot of equity in the house. And obviously the borrower wanted to keep it because they're paying the first mortgage. Why they stopped paying the second, we'll never know. The good news for us is we're able to buy that note at a really good price, roughly $16,000. tried to work with the borrower, weren't able to get in touch with them, and ultimately wound up taking that particular property to foreclosure. When we got to foreclosure, the judge said, "How much do they owe?" Total owed was $92,000. So if you sit back and you look at, we invested 16,000, we ultimately got $92,000 for that note. It's a 578% return. That's what I mean by we get great capital appreciation. A $16,000 investment, a $92,000 return. And oh, by the way, that was in 18 months. That's not something you're going to be able to do in any other asset class where you know that you have a secure underlying asset that's buffeting up your note. I mentioned earlier that I was going to talk to you a little bit about the returns from the covenant fund. In the covenant fund, the way we've set it up, there are there are four classes of investors. Class A investors are those that invest over $1 million. They get a 12% annual return on their money paid out quarterly. A Class B investor is 150 to $1 million. They get a 10% annual return on their investment. Class C, 75,000 to 150, a 9% return. And then a Class D is an 8% return for a $25,000 to $75,000 investment. In addition to those returns, as we mentioned, when we close out the fund, all of our investors get 100% of their capital back, but they also get a prorated share, half of the profits on a prorated share based on their investments. So you get the steady annual return plus the kicker at the end of whatever profits we make. Sorry about that. At this point, I'd like to find out if there are any questions that we have from folks that have been involved in that have been listening to the podcast or the webinar. So, Raman, do you have any questions in the chat?
One question in the chat: how come layoffs and the shift in the economy doesn't affect note investments?
Good question. And again, part of the reason for that is that we have a steady cash stream. And even when things are really bad in the economy, most people pay their mortgages. So as a result, that steady, consistent cash flow results in us having a safe, I shouldn't say safe, a secure asset to invest in.
I'd like to expound on that a little bit, if you don't mind.
Please.
I think too that, when you think about notes, right? Once the promissory note is created, where there is a debt that must be satisfied, as Jerry went over the three immutable facts, it doesn't matter what's happening on Wall Street. It doesn't matter what's going on with this shift. This is still a note that has to be satisfied, and so it must be paid. And then unfortunately, the worst case scenario is that if we have to go into foreclosure, we go into foreclosure so that the debt is satisfied. And so that is the rule. I mean, that is the process. That is what the cycle of the note goes through. And so all the other changes that are going on that seem to be affected by the shift in the economy, now we're looking at a change of administration, the dynamics that are going on in Wall Street. It doesn't matter. It doesn't change that there's still a note that needs to be satisfied, and it will get satisfied. Hopefully, for the best case for the borrower, but ultimately, foreclosure will satisfy that note. So, which is why it always seems to be able to do well in times of when they're difficult, and people they'll let everything else go and they'll pay their note because they need some place to live. And so we have a couple of historic times that, proved that. Like, we just COVID, for example, right? COVID, we went through COVID, and notes fared well, unlike any other asset during that time. The 2008 crash, right? The real estate crash. And that was one of the best times for mortgage notes investment. So there's some proven times that no matter what's going on, the investment in the notes is still holds fast to the rules that you must follow, so that the debt is satisfied. Just wanted to really get into that because people are a little concerned right now with what's going on in the market. There's a lot of things that are going on in the news about different markets and different places, and they're not doing well. And, Florida has its own saga with all of the changes with the insurance, and everybody's taxes are going up because of climate change. Doesn't matter. The note still must be satisfied. And so if you're thinking about, what you could do to stabilize your portfolio, I just can't think of a better asset to invest in at this time other than notes.
Agreed.
Mm.
And that's a good, and I'm glad you mentioned COVID, because one of the things that we were expecting when the pandemic hit was that people would defer making their mortgage payments. And even though, the government had some deferral programs and whatever, what we saw was everyone kept making the payments.
Right.
And that was kind of the aha moment for everyone in the note space, and gave all of us that were invested in the space a lot more comfort, knowing that even though we understood that people would pay, even during an extreme period like that, people kept paying. So
People kept paying.
great investment and
Hey,
and we got
Jerry.
great returns.
Oops, I'm sorry.
Yep. Go on, Raman.
This the idea that 50% of the overall profits will be dispersed to the investors at the sunset of the fund on a prorated basis appears to be atypical for the industry. Can you elaborate on that a little more?
Sure. And it's interesting. That's a really good question, Raman. When we were putting the fund together, there was a lot of debate on how to reimburse your investors with the proceeds of the fund. And typically in this space, it's a 20-80 split, where 20% goes to the investors and 80% goes to the fund owners. One of the things that we wanted to do, and when we get back to why did we set up this fund, we wanted to be able to share our expertise with a lot more people. And our feeling was, hey, why not provide half the profits and give them back to the investors? Made sense to us, and that's why we did it. It's more a matter of just trying to make sure we're spreading it around. We know we will do well, and to be able to help other folks realize what we're seeing, I think is a win for all of us. Also, it exposes people to the world of notes, and hopefully will help to grow the note investment world.
Okay. We have another question.
Yeah.
Can you please repeat the case study example of the second purchased for 16K and worth 92K over 18 months?
Sure. I can do
I know
that.
it seems like impossible, but it does happen. We've all had that
Yeah.
experience
All
as
right.
investors.
It was a great day in the office, I can tell you that.
Yeah.
Well,
And
that's what attracted us all to this business, with those
That's
kinds of
right, right,
returns,
right.
because they do happen.
so I'll go back through this one, and I'll try to paint a little bit more of the story behind it. So the property was owned by an investor, and this investor owned, I don't know, half a dozen properties around the Baltimore, Washington, Virginia area. This particular property, for whatever reason, I don't understand. He'd let it sit there. And as I mentioned, it's worth about $500,000. He's paying the first mortgage. And when we look at a note and we look at buying these things, we look at how much equity is on the note above what we are owed. In this case, equity is 171,000. The reason I was able to get this note for $16,000 is that the owners of the note, just like the investor that owned the property, had not done anything with it. It was in their portfolio. They're a big hedge fund, and it was just sitting there, and they're closing out their portfolio. So I offered them 16,000. They took my 16,000. They gave it to me. So basically, in a lot of cases, what happens with, and what I'll tell a hedge fund or I'll tell a bank is, I want your trash. And this is what that hedge fund thought the trash was worth. In my case, I looked at it. I said, it's a $500,000 house, $171,000 of equity. I know I can get something more than $16,000 for that note. And that result, if you take what the note, the amount of principal that had not been paid on the note and the unpaid interest, that's how we got to the 92.
And I'm sorry, and I'll just add that, you know, most of us that have been involved in real estate, a lot of it's been like flipping houses or doing rentals and stuff like that.
Yeah,
And it's not uncommon to see those kinds of returns when you do a flip or that kind of thing. But this, it almost offers the best of both worlds because you're not getting your hands dirty with, brick and mortar.
true.
So I I can certainly attest to the return on that case study because I've experienced it also.
Yeah, and it's. I'm glad you brought up. Folks are used to doing fix and flips. A non-performing loan for us is a fixer-upper. For folks that are in the hard real estate space, that's how we look at it. It's a fixer-upper. And we buy the note, we fix it, and then our flip is what we get on the backside when we get the note paid off. So another way to think about it, to the person that asked the question, is think about doing finding a house for tax that's been taken back on taxes, finding a house that has been abandoned around the corner someplace, getting a hold of it, rehabbing it, and then putting it on the market. You're going to make some pretty good money. In our case, we're doing that same thing, but I don't have to swing a hammer. I don't have to paint anything in order to get that kind of a return.
Yeah, and thank you, Nancy, for that question. We appreciate that.
Yeah.
I don't see any other questions in the chat at the moment, Jerry.
Okay. So if there are no other questions, want to go back to the Q&A slide, Kim?
May I ask a question, Mr. Jerry?
Sure.
So I know you maybe did go over this, but how long has this fund been in existence?
Well, we just set up Covenant Fund.
I
Okay.
think it
So
started in September.
yeah, so we started Covenant Fund in September, and we've been investing in notes, as a team, since 2017, something like that. But the
Yes.
fund itself, we're just setting it up, just getting our first investors in on board.
And I heard you say the returns. I don't know if you can go over the slide that says what the minimum contributions are that you guys are seeking.
Sure. Kim, you want to go back to 16? So for the fund, there are going to be 4 classes of investors. And the return that you get is based on the investment level that you have. We have a 25,000 level, 75, 150, and then the $1 million level. returns are going to be based on that. So there's an annual interest payment paid out quarterly, ranging from 8% up to 12%. In addition to that, as I mentioned, we will also be dispersing half of the profits in the fund back to the investors.
Are you paying monthly to the investors or quarterly?
It's a quarterly distribution.
Okay.
And it begins the quarter, either the quarter right after you invest or the quarter that you invest. And I have to go back and I don't recall exactly which, but
It's the quarter after.
Quarter after, okay. So it's a fairly, you invest and you're going to start getting a return.
And I guess only my one other question, please. I apologize.
No
But
worries.
let's say that most of my investments right now are actually in the house, in the home.
Mhm.
What do you suggest for uh, someone like me who, and I think Mr. Desi, he went over equity yesterday
Yeah.
on the masterclass, but most of my money is tied up inside the house.
So one of the things that we do we typically sit down with investors and we'll do something that we call an investment audit to kind of help walk you through what are your interests, what are your needs, what are you trying to do? Are you trying to build appreciation or are you trying to build regular income, steady income, to try to figure out what works best for you? So what I would suggest, I know you and I have been communicating before, so I think the best suggestion for you is let's get on my calendar and we'll sit down and just sort of go through an audit and see what works for you.
There would be opportunity to be able to tap into the equity to be able to reinvest. Is that what you were looking for? Is that the answer you were looking for?
Yes, that's. I'm just looking to see what I think I heard you. I think I heard Mr. Jerry mention that you have maybe a mortgage guy on your investment team. So just looking how to kind of get the equity out of the home.
Yeah,
Yeah.
that's Raman's world.
So we do have another question.
Yeah.
Does cashing out the note usually occur in a foreclosure situation? Thank you, Frederick, for that.
Good question. Not necessarily. What I've experienced with most of my notes is that, and again, a lot of it's because we're buying a lot of non-performing seconds, but many of the folks either refi their houses. So that's one of the cash events that we'll see. There are other cases where they sell the house, which is another a cash event that happens. So typically foreclosure is way down on my list. One of the reasons for that is that for the most part, when you read your mortgage, our borrowers are required to pay the legal fees, but I have to front them. So we try our best not to get into foreclosure if it's at all possible.
Mm-hmm.
And it's mainly just because it's a cash flow hit.
And most of our experiences are that, with the second liens, somehow or another, there's a miss with the owners realizing they have another mortgage to satisfy.
Yeah.
And so, we don't know if that's because of their own personal dynamics. Sometimes it's a divorce, move, separation, COVID kind of messed up the rhythm of payments. People didn't realize when they were supposed to pay, when not to pay, because remember there was a moratorium that went into effect. And so when they started back up, people started paying the first, but not paying the second. So there's lots of reasons that take place why these notes are not being paid. And so when we engage the borrower, they're very much interested in working out a payment plan. They're very much interested in bringing the note to current, making it current. And sometimes those payouts look different. Sometimes there's a down payment, and then there's a loan mod on the note itself. So to Jerry's point, it is more so than not that they just want to make sure that they get back in good graces with their responsibility, as opposed to moving it into foreclosure.
Yeah.
And
You know,
you
one of
turn
the,
the note into
yeah,
a performing note as well, I guess, right?
yeah,
Yes.
absolutely, Fred. You know, one of the
Hey, Jerry.
things that, yeah, it's, I've known this guy forever, so.
Okay. Hi, Fred.
No, he wasn't a plant. But one of the things that we've found, particularly with seconds, is that folks forget about them.
Yeah. I don't know why.
And it's not uncommon that we'll buy a note and then all of a sudden you get one giant catch-up payment.
Mhm.
And a lot of that's because, like I said, people forgot. As Kim mentioned, there may be a death in the family. One spouse is paying the bills, the other one doesn't know. The other thing that I find, and you know, all of us that are homeowners have experienced this, when you buy a house and you take out a mortgage, your loan is sold. And what I have seen on some of these loans, and that DC loan was a good example of that, the loan was sold from one entity to another entity to another entity to another entity. And people just go, well, who do I send my payments to? So
Yeah,
I've had
right.
situations where I've talked to borrowers and it's like, well, we couldn't figure out who to send the payment to.
Brilliant.
And, you know, so, and I remember fairly recently, I was on a call, I got a phone call out of the blue. A borrower had called our servicing company. The servicing company said, call Jerry. So they called me up and it's like, well, how much do I owe and where do I send the money? And and we owned that note for what, 5 weeks, and it was now caught up. It was current.
Yeah.
So that's what you'll see. So you'll see a whole plethora of ways that people ultimately cash out, or we have a cash event with the note, not always with a foreclosure. The other way that we will see a cash event is, you know, I buy a note at a very deep discount. I get it to perform. I get 6 months, 12 months of payments. I'll sell that note. There are banks that will buy the note back from us at par, and in some cases a little bit above par.
All right, Jerry, we have one more
Okay.
from CS. What is the risk mitigation you have in place in case if miss the investor payment? If I don't know, does that make sense? If so, what is the
So
risk mitigation you have in place in case we miss the investor payment? I think that's what
yeah,
that's.
so one of the things that we do is we have a reserve fund. We don't invest 100% of the capital that we have. We have a reserve fund for to make sure that we're able to make our interest payments, but also in case for any legal fees that come up if we do have to go to foreclosure. So we maintain a level of liquidity to make sure that we are always that we always have a way to be able to cover any expenses that come down the pike for us.
I like to also add that we also have in-house inventory. So that's not something an investor would even know took place, or that event is even happening. Because we'll switch out notes that may be going through a transition and put in a different note that is still being paid as agreed, if you will. And so we're constantly looking at keeping everything solid in regards to making sure the investor is never impacted by any dynamics that are going on with the notes.
Yeah, I mean we're all fully invested in this on a personal level also. So
Yeah.
we won't let our investors miss any payments, if that's the question.
Any other questions?
I see. Was there
Um,
still something in
I,
the chat?
I don't see any more in the chat. think that was
Yeah,
the
I think we're
last
good.
All right.
one.
You want to pull up slide 18 and we'll kind of wrap up. So for those of you that would like to get some more information, to talk a little bit more in depth about the note space or what we're doing with the notes, you can click on the URL here, and that will take you right to my calendar. We can schedule some time to talk, and I can tell you some more about what we're doing, give you some more details. And also, as I mentioned to Caron earlier, that may be a chance for us to sit down and talk you through an investment audit so that you can look at your portfolio and figure out what do you want to do. With that, I'd
Oh,
like to.
can we plug the summit?
Oh yeah, forgot about that.
Yeah, you got a summit. You know, and it has a lot to do with our fund. And it's a bigger picture in regard to not just investing in notes, but really making your portfolio healthy, and it protects your assets and optimize your returns. This is probably going to be a one-day summit like no other. Very excited about our speakers, the opportunity to bring about awareness on what's the best way to invest, as well as looking at some tax strategies in regard to this. And so this is all going to take place. Our website will be updated this week to also have the link on our website. But April 5th, Ponte Vedra, say it, Ponte Vedra,
Ponte
Florida.
Vedra, Florida.
Yes, Sawgrass Marriott. And we do have a block of hotels if you're interested, discounted deeply for anyone that wants to come to the summit. And that property is fantastic. As far as if you're coming, you might want to take an extra day just to be able to enjoy the property, because a lot comes with your reservation as well. So look for the new link on our website to be able to get more details about the summit, which is really to bring about the awareness for the fund.
And any golfers, bring your sticks with you.
Bring your sticks.
All right.
Thank you, everyone that came, and appreciate your questions. And don't hesitate to, get on the calendar and chit chat and see if what not works today might work tomorrow for you. There's always opportunity.
All right. Thanks a lot. Thanks for sharing.
All right,
Thank
thanks,
you very
guys.
much.
Appreciate it.
Appreciate it.
Thank you.
Bye-bye.
Bye-bye.